I want to start by revisiting the Shiller PE ratio that we were looking at in January 7th of this year. Now, this is really what's interesting. I always like looking at the valuation of the overall stock market just to understand where we are, big picture. And we're definitely in this overvalued stage. That doesn't mean the market can't keep running and doing well for a while, but we're really overvalued. And I'm going to show you a couple of charts as to what that means going forward and why I care so much. This is the first time I've actually shown that. But the best part is showing this is where we were at the beginning of the year, and then where are we now? That's where we are now. Beginning of the year, here's where we are now, right? So we've really jumped in the valuation of having the market being overvalued now, and it's not the greatest thing, but it's been good for the market overall. But that will lead to other things in the future. Crestmont Research does an amazing job of doing data research on this kind of stuff, and these little peaks here correspond with the peaks of the valuation data of the market. So keep these peaks in mind when we're looking at this other chart. This is 29, this is 2000, this is now. Right, 29, here was the peak. And what happens at the peak? What they found is typically anytime the valuation is up over 25, which is this old metric, and this goes back to 1800, anytime the valuation goes up that high, the expected return of the S&P or the markets overall for the next decade is zero, right? They don't expect that. It doesn't mean the market's going to just go flat and do nothing. It means there's going to be ups, there's going to be downs, probably more ups than downs, and maybe it'll recover at the end. So back in 29, I mean, this took a while to get back to even the 70s. This is actually what led me to this. I was thinking about inflation and the current issues that we are facing. Inflation does seem to be out of control now, as it did back there. I know they're liking to say that it's not an issue, but it really seems to be. And what can happen? But really, when you're thinking of how to deal with that, one of the best ways to deal with inflation is to be in the stock market, believe it or not. Gold is an okay inflation, but it's not really an inflation hedge like it's made out to be. Typically, it's more of a random asset. It doesn't really always follow. Sometimes it does, sometimes it doesn't, but it's not really a proper inflation hedge. But actually owning the market is a better place to be. Now, what this also kind of tells us is that when we're in this situation, once we've had a peak and then we're coming down and having a flat decade, honestly, much like we did in 2000, there's going to be ups and there's going to be downs. You've got to be very active and proactive of being in the market when it's good and out of the market when it's bad, and that can turn very quickly. Not that that's good or bad. I think for what we do, this is an ideal time to do what we do because we're very good at missing out on big down markets and catching a good amount of the upside. But the downside is always the top priority of not getting hit and losing money. So that's just something I'm looking at and thinking about, and I hope this context helps you understand why I think about this number so much, because we're way back up here again, and that's not promising going forward. So diving back into the usual stuff, long-term trend. Back last month, we were just peaking out right there when we had the webinar, and we've had a great run since. Kind of all systems go on the long-term trend. Advanced decline is good. A lot more stocks are going up and down in the New York Stock Exchange, and that really is what drives this indicator. Next up, we have the midterm cycle. This really is a little more micro and how we trade some of the strategies. I wanted to kind of show you this because back in September, we were out for most of it, had this little fake out, which hit us a little more than I would have liked. We missed out the rest. And then it was around 10th or around 8th of October. We had a good buy signal and we've been all in since. And today, the last couple of days looked ugly and it's been coming down, but it never said to get out. And that's good because today is bouncing back really well and we're still in it very aggressively in the market. So that's pretty positive. And what this is showing is money coming into the market and money coming out of the market. So when money's coming in, you want to be invested. When money's coming out, you really want to take it easy and start, as Phil likes to say, put on the brakes and slow things down. So if the market really does fall hard, I'll understand. But I'm going to show you this little thing and how that plays out with the S&P. So here's where early September, we had the sell signal. We missed out on all this. Yay. And then it came back up and actually we had the buy signal there. And this one little day got us because it was a fake out. I mean, it's what happens. So we were out most of that, but that new buy signal came in around there and we've been all in and aggressive for this whole run. And this has been one of the best runs we've had all year. So I'm very happy with how we've done that. We've made up a lot of ground that I felt like we were we were lagging this year. So we're in a much better place. And I'm really happy to see that. But even this MACD on this is slowing down. This could be, I don't know how much more we're going to push them here. The good part is already done. So maybe it's going to chop sideways going forward. There's some interesting stuff on time cycles I wanted to get into at some other point, but showing that there's this cycle of about 25 days where we have 25 up and then 25 down to cautious. So we're kind of coming into that second set. And it's just interesting to know, but this was planned to be easy basically on time. And then this next 20 days going forward, really through the end of, really through mid-December probably is going to be a little more headwinds, I would say. Doesn't mean the market's going to go down. I mean, it's going to be, you got to be cautious and quick. And if something goes wrong, you want to be on top of it. That's what we do. Sectors positive 8-3. That's better than we've had quite some time. We were at 10 for 11. We were all in on all sectors for most of that run, although communication has been out for a bit. That's largely like the Facebooks and the Googles, which is interesting. They're having a bit of a struggle, but we've been seeing, weakness creeping in, but today might undo that. So I'm not too concerned about that, but it's just always interesting to see where things lie, positive to negative. And that's about that. I did have a couple questions about the debt ceiling in December, and I it's really not an issue. I don't think, based on what we do, money flow is going to determine whether we're in the market or not, and it's always going to be a big show. So it's usually a day or two of volatility, but that's about it. Whatever the market's trend is, it usually continues around those issues. So I'm not too concerned about that.